Some strategists look at the bond market and see potential signs that a recession is on the horizon. But recent economic reports have not been that bad. So what exactly is the data saying? Steve Liesman takes a look.
The bond market acting as if it's certain a sharp weakening of the economy is on the way, even a recession. And the stock market acting as if the bond market is right. In one corner, an inverted yield curve where shorter-term treasuries yield more than longer ones, the opposite of what it should be, and a sign that bond investors believe the economy will weaken and the Fed will have to cut rates and stimulate the economy. Most of the time when the yield curve inverts, a recession is not far off. But that's not obvious from looking at either the current economic data or economic forecasts. Unemployment is running a low 3.6%. Three-month average job creation, 169,000, which comes along with strong consumer confidence. Inflation is running below the Fed's 2% target, but not that far at 1.6%. And first quarter GDP was 3.2%, well above trend. And the estimates from the CNBC Rapid Update are for 1.6% growth in the second quarter. That'll reverse some, but not all of the trade-distorted strength of the first quarter. It's weaker, but again, still around trend and certainly not a recession. A weakening in growth was expected this year. The question now is whether the escalating trade war between the U.S. and China makes it worse, and so the Fed now has to cut rates in response. That's what the bond market is banking on. It's pricing in an 85% probability of a rate cut by year end. Where's the Fed? They see trade as a risk, but have announced they're going to wait and see for the effects on the real economy before they act. For Nightly Business Report, I'm Steve Liesman.